Hi, and welcome to topic 3, weighted cost of capital. So in this lecture, we look at firstly the relationship between risk return and the cost of capital. We then look at the implication of taxes for the calculation of the cost of capital. We then bring everything together and estimate the company's overall cost of capital as the weighted average cost of individual capital items. We then look at individual projects' cost of capital. And finally, we look at a diversified company's cost of capital. So in terms of the learning objectives, for this topic, we introduce firstly the concept of the cost of capital. So this is not something new. This is what we've been doing before. So when we evaluate a project using the NPV method, for example, the rate of return or the discount rate, so case 0, the discount rate that we use for NPV analysis is basically the cost of capital. So in this topic, we're looking at how to compute the cost of capital. We then look at the effect of risk on the measure of the cost of capital. So there are two types of risk, business risk and financing risk. So we mentioned before that the project's cost of capital should be depending on just the volatility of the cash flows of the project. So just depending on the business risk of the firm. The financing risk is reflected in the cost of equity, right? We also look at the impact of the imputation tax system on the measure of the cost of capital. We then do an exercise where we combine all the different items, different sources of capital to measure the overall or the weighted average cost of capital. We then look at a case where the project's risk is different from the firm's risk, and therefore we need to somehow adjust for the project's riskiness in our calculation. So we have to understand the difference between the overall cost of capital and the project's cost of capital. So we mentioned before that the project's cost of capital should be depending on the project riskiness, not the overall firm's riskiness. We then look at estimating the cost of capital for one division of a company with a lot of divisions. The readings for this lecture is from chapter 14 in the textbook. So in relation to the cost of capital, this is what we mentioned before in project evaluation. So in calculating the NPV, this is related to the investment decisions. We want to choose the projects with the highest NPVs. So in the calculation of the NPV, we take K as given, so K is our discount rate. So the purpose of this topic today is to look at how to measure K here. So this is related to the financing decisions. Okay. So the cost of capital is simply just the weighted cost or the average costs of different types of capital that we use. Assuming that we have only two types of capital, either debt or equity, then the total or the overall cost of capital of the firm is the weighted average cost of different sources of debt and different sources of equity, right? Okay, so the weighted cost of capital here is simply just the average of all of the types of finance in the company's capital structure. The capital structure is what we introduced in the previous topic. This is just a mix of debt and equity, right? So here once again we assume that the firm belongs to just shareholders and debt holders, right? So the financial suppliers, and therefore the value of the firm is simply just a composition of the value of equity and the value of debt. So suppose that we have 40% in equity and 60% in debt, right? So the weight of equity is 40%. The weight of debt is just 1 minus 40%. Yeah. We mentioned from last week that the larger the proportion of debt, the higher the financing risk, and therefore the higher default risk as well. Yeah. And the financial risk is borne by the equity holders. Yeah. Okay, so the cost of capital, we also think about the cost of capital as the investor's required rate of return. Right? So it basically means that this is how much the investor expects the firm to pay them in terms of financial output for their investment in the firm. Right. We can also think of the cost of capital as the opportunity costs that we have to compensate to the investors for committing the fund into the firm. Right. So, for example, if the firm's risk or the project's risk is equivalent to another investment outside in the market, which is a triple A bond, right? And currently these bonds are traded at 10%. This means that the investor can invest in the bond for 10%. However, if they choose to invest in your project, that means that they expect that at least they would get 10% back from the project. Yeah. Otherwise, they would be better off choosing the triple A bond. So we assume that the overall company's cost of capital is equal to the weighted average of all the different types of finance, all the costs of all the different types of finance. The project's cost of capital can be different from a company's overall cost of capital because, as we mentioned before, one principle of evaluating a project is that the project should be evaluated based on its own risk, right? Not on the overall firm's risk. So, as we mentioned before, there are two types of finance that the firm can use, either equity or debt. Therefore, there are two main components of a weighted cost of capital computation. We have the cost of equity, the overall cost of equity, and we have the overall cost of debt. Yeah. So for each of these items here, these are the overall costs of all the types of equity that the firm has, and this is the overall cost of all the debt that the firm has, right? We also assume that the firm is a going concern. So when we evaluate the cost, the required rate of return for equity securities, we assume that the firm is a going concern. So given this assumption, we can then use the perpetuity formula to price the firm's securities, right? To price the firm's equity securities. Without this assumption, we can't use the perpetuity formula. Right. So the weighted cost of capital is expressed in this equation here. This is the overall cost of capital of the firm. So this is the weighted average cost of capital. This is equal to the weighted average after-tax cost of debt and the weighted average cost of equity, right? So this equation has two components. The first one being the after-tax cost of debt, yeah? So here we take into account the effect of taxes on the cost of different types of finance, yeah? This is the weight of debt and this is the weight of equity, right? So with equity financing, we don't have any debt, tax benefits, and therefore the after-tax cost of equity is exactly equal to the before-tax cost of equity. Right. We also have this equation here. This is simply just the value of the firm is equal to the value distributed to shareholders and the value distributed to debt holders. Yeah. So we look at the cost of equity first. KE, right? So to compute the cost of equity, because we made the assumption before that the cost of capital is simply just the required rate of return on capital, right? So to measure the cost of equity, therefore, we calculate the required rate of return on equity. Yeah. We have two types of equity. We have common shares and we have preference shares. So with common shares, what happens is the return on common shares reflects the firm business risk, right? Because common shares, the value of common shares is the residual value from the firm cash flows. Yeah. So the common shares have the same volatility as the business risk plus the financing risk, right? So common equity holders bear the default risk of the firm. Whereas for preference shares tend to be a little bit in between of a straight equity being common equity and the straight debt, right? So with preference shares, they are still a share. So the firm don't have to pay the principal back. But the dividends on preference shares cannot be skipped, right? So dividends on common shares tend to be cumulative, meaning that if the firm cannot pay the dividends in the current year, they have to pay the dividend back in the next year when they make profits. Yeah. Preference shares also don't have voting rights, so the payment structure of preference shares is a bit different, and the voting rights of preference shares are also different. Therefore, the risk that preference shareholders is exposed to is a bit different from the company's risk. Yeah. So in general, preference shares tend to be less risky than common shares because the dividends in preference shares cannot be skipped, right? So if we were to compute the required rate of return on equity, we have two models that we can use. Now, because the riskiness of common shares reflect the riskiness of the firm, we therefore can use the CAPM model to estimate the return on common shares, right, using the systematic risk of the firm. Okay. We also have the dividend discount model, where if we estimate the dividends on common shares, we can use the perpetuity formula to work out the required rate of return in the model. Yeah. So this slide sums up the two methods that we talked about before. We have the CAPM model, where we use the firm's systematic risk to estimate the required rate of return on common equity. Right. We also have the dividend discount model, where if we can observe the dividends of a firm, if we have a stable firm that have a stable dividend payout policy, we can then use the dividend discount model to work out the to work out the expected rate of return on the shares, right, based on the current market price and the dividends. So in an exam question, if we see the question giving us beta, market returns, or the risk-free rates, we know that we have to use the CAPM model, right, to work out the cost of equity. Whereas if the question gives us the dividends and the current market price and also a growth estimate for the dividend discount model, we know that we are using the dividend discount model, right? Okay. So these are the main assumptions of these different models, and therefore the limitations of the model as well, right? In terms of preference shares is a bit different from common shares, as we mentioned before, because preference shares they have a less exposure to risk, right? Also, the dividends payable on preference shares tend to be fixed, and they tend to be paid half yearly, right? So given that the dividend is fixed, there's no growth rate for the dividend. The value formula for the preference shares is only the normal perpetuity formula, right? So we have current price equal to the dividend payable on preference shares divided by the required rate of return on preference shares, yeah? So this is what we want to work out, yeah? So we want to work out the cost of preference shares, which is the required rate of return on the preference shares, yeah? So if we can observe the market price for preference shares, and if we can observe the dividends payable on preference shares, we can rearrange the equation by taking I to this side and taking P to this side and work out the I, yeah? We then turn to the cost of debt. Also, in these kind of calculations, what we care about is the effective costs of these items, yeah? So we have the effective costs of equity. We also have the effective cost of debt, right? In addition, besides the effective cost of debt, with debt financing, we have to also adjust for taxes, yeah? Because interest expenses on debt are tax deductible, therefore the after-tax cost of debt will be different from the before-tax cost of debt, right? The after-tax cost of debt should be lower than the before-tax cost of debt because that has a tax shield, right? Also notice that the tax rate that we use here in the calculation of the after-tax cost of debt is the effective company tax rate, right? So this rate takes into account all the different tax credits that the firm has. For example, under the imputation tax system, we have the franking credit, right? Companies also have investment tax credits, meaning that if they make certain types of investments, they will be entitled to tax credits on these investments, yeah? So in terms of the different types of debt, the total cost of debt is simply just the weighted average cost of all the different types of debt, right? So what are the different types of debt that the firm can borrow from? We have bank loans, bank loans, for example, term loans, they tend to be annuities, right? So they have fixed payments per year, per month, so on and so forth, and they have a fixed maturity, right? So the payments of loan payments tend to be fixed and equal for each period, and therefore we use the annuity formula to work out the costs of bank loans, right? We also have short-term discount securities. So with these securities, the valuation formula for these securities are quite simple compared to the annuity formula. We have price or present value equals to the face value divided by 1 plus R times the number of days to maturity divided by 365, yeah? We also have bonds. So bonds are long-term public securities, right? So the payment structure of bonds include coupon payments, so interim payments being coupon payments, plus a face value payment at the end as well, right? At the end of the maturity. So with bond investments, coupon payments tend to be semi-annual. So the default is semi-annual payment. So with a bond valuation, therefore, we have two types of cash flow. We have an annuity comprising of the coupon payments, and we also have a present value component, which is the face value discounted back to the current time, right? So for each of these items here, what we want to work out is we want to work out the cost of debt, right? Which is the required rate of return for each of the securities, yeah? So it's the R in each formula or the I in each formula, right? So we look at before the different types of debt and different types of equity and how we can price these different securities. Now we look at the impact of taxes in the formula, yeah? So what are the different effects of taxes on our calculation of the weighted cost of capital? So we mentioned before that debt financing has tax shields, being the interest expenses, being the tax deductible on interest expenses, yeah? Therefore, the after-tax cost of debt would be reduced compared to the before tax cost of debt, yeah? With relation to the cost of equity, we know that the dividend payments are not tax deductible. However, with the imputation tax system, we have a tax benefits of dividend payments, right? So in the imputation tax system, investors are entitled to a dividend franking credits, and that reduces the after-tax payment, right? Okay. So how does the imputation tax system affects the taxes of a firm? So with the imputation tax system, the company first pays tax on dividend payments. However, the shareholders get back the franking credits from the companies, and they can use that to offset their other tax expenses. Or if they don't have any other tax expenses, they can get the refund from the tax office, right? So effectively, that means that shareholders' income from dividend is only taxed once at the personal tax rate, right? So the effective tax that the company pays in this case can be reduced by the amount of franking credits, yeah? Dividends might not be fully franked, meaning that if a company doesn't pay out the entire tax payment in franking credits, then they still have to pay a little bit of tax, yeah? Also, for tax purposes, only shareholders that are Australian citizens can get the franking credits, right? So how does that affect the company's tax rates, yeah? So we mentioned before that under the imputation tax system, the company pay tax first. So the government collects taxes from the company. So with the amount of taxes collected at the company level, it includes two components. The first component is the prepayment of personal taxes, which is then paid back to the shareholders in the form of tax credits, right? So this is the franked component. For the unfranked component, this is the actual taxes that the company has to pay, right? So this is the effective tax payments that the company has to make. Okay. As a result, the actual taxes that the company have to pay is only a proportion of the statutory or the corporate tax rate, right? So after we adjust for the franking credit, this is how much taxes that the company has to pay, yeah? Okay. So TC here in the equation is the corporate tax rate, normally 30%, right? Gamma here is the proportion of tax collected from a company that is paid out to shareholders and recovered through tax credits, right? So this is the franking component that we talked about before. Okay. So once we work out the effective tax rate of a firm, we can then work out the after-tax cost of debt, right? So here we have an example where the company pays KD% per annum in interest expenses, right? So for every $100 in debt, they pay KD dollars, yeah? The company tax rate is T. We know that debt payment is tax deductible. So out of this KD dollars, the company can save this much amount in taxes, yeah? Therefore, the effective cost of debt, or the amount, the net amount that the company has to expense after taking into account the tax shield on debt, is just this proportion, right? So this is the amount of tax savings. This is the net amount of the cost of debt, right? So if we take this divided by 100, it will give us the rate, right? So the after-tax percentage cost of debt is only KD times 1 minus the tax rate, yeah? So let's put it all together. So we talk about the effect of the imputation tax system, or different types of tax credits, on the effective tax rates of the firm. We then look at the after-tax required rate of return by debt holders, or the after-tax cost of debt. And finally, we look at the rate of return for shareholders, right? So we look at different types of formulas that we use in debt and equity security pricing. So we're going to use these formulas to work out the required rate of return, or the I or the R in the formulas, right? Next, we're looking at the weights of debt and equity, right? So with debt and equity, we also have the security issuance cost as well, besides the debt and equity weights. In terms of the weights of debt and equity, here we use the market values of debt and equity to work out the weights of the different securities, right? So what we care about is the market value of the firm, and therefore in the weights that we use in the weighted cost of capital, we use the market values of debt and market values of equity. Right. So let's look at an example where we implement the weighted cost of capital calculation, right? So in this case, we have a firm that has a 20-year bond debt issuance, and the debt was issued in 2014, right? The face value is $16 million. The current bond price is 110% of the face value, yeah? So the face value was $16 million. The current traded price is at 1.1 times $16 million, yeah? The book value of equity is $50 million. We have the number of shares. We also have the current share price, the current market price for the shares, right? We estimated that the cost of debt is 7%. This is before tax, yeah? And the cost of equity is 12%. Okay. Assuming that the effective tax rate is 30%, what would be the weighted cost of capital for Facebook, yeah? So we work through the exercise, starting with the equation, right? So we have the weighted cost of capital being the weighted cost of equity. So I'm arranging the equity formula first because it's simple. And then we have the after-tax cost of debt, yeah? So in this calculation, we only have two types of finance. We have an equity finance and a debt finance. Yeah. Therefore, we only have two components for this formula. The tax rate here is the effective tax rate. Yeah. So with debt, we know that we have to work out the after-tax cost of debt, KD times 1 minus TE. So we have KD, we have TE. In this case, we have no further information about the effective tax rate. Therefore, we're just going to apply the statutory tax rate in this calculation, right? So 7% times 70% gives us 4.9%, right? The cost of equity doesn't have to be adjusted because we have no tax shield on equity payments, right? From the information from the question, we know that the market value of debt is 110% of the face value. So this is 17.6 million, right? The market value of equity is given by the current market price per share times the number of shares, yeah? So this is 45 million. Firm value is therefore just the sum of the market value of debt and the market value of equity. So it's 62.6 million, yeah? So we put everything in the formula. This is the after-tax cost of debt. The weight of debt is given by the market value of debt divided by the total firm value, yeah? Similarly, this is the cost of equity. And the weight for equity is just equity divided by the total firm value, right? So it gives us 10% per annum. We then look at the impact of security issuance costs on the cost of capital, right? So security issuance cost is a one-off cost. So when we issue a security, we have to pay all the underwriting fees, legal fees, so on and so forth. But these costs are only incurred once, yeah? So these costs only happens at the time that we have to issue the security. So it's not an ongoing cost, yeah? Whereas the cost of capital is a per annum measure, right? So this is an ongoing cost. So how do we treat issuance costs then? So the proper way to treat issuance costs, given that it's a one-off cost, is that we just have to account for it at the time that it incurs, right? So suppose that we have to consider to invest in a project today. If we invest in this project, we have to raise $2 million in debt financing, right, from issuing into the bond market. So if we were to choose this project, we would also incur the issuance costs of the bond issuance, right, today. So the issuance cost is therefore should be deducted from the cash flows today, yeah? So it should be treated in the cash flows, not in the cost of capital, right? So let's look at an example where we see how we can adjust for the issuance costs in a project evaluation case, right? So we have this company wanting to acquire another company, and the cost of acquisition is $300 million, right? So this is our I0, the initial outlay in the NPV formula, right? So to finance this acquisition, the company has to raise additional debt, and the issuance cost for this debt is $20 million, right? We also know some information about the cash flows of the firm. So the after-tax cash flows from this acquisition is expected to be $35 million in the first year, and it grows at 3% per year forever. So when we see the word forever, we know that we're dealing with a perpetuity, right? We have an estimate for the cost of capital. The question here is, should the company go ahead with this proposal, right? So if we were to use the NPV method, to evaluate this project, what will be our decision rule, right? We should accept the project if the NPV is more than 0, yeah? So for this exercise, we therefore have to consider all the cash flows in the future as well as the initial outlay, yeah? So as we mentioned before, the issuance costs should be treated as a deduction from the cash flows at the time that we issue the security, yeah? So if we were to buy the company today, we have to issue the security today as well, right? Therefore, the issuance cost would be a negative cash flow happening at time 0, yeah? The other two components of this formula is exactly the same as our normal NPV formula, right? So our initial outlay is $300 million. The issuance cost is $20 million. This sum over here, so we know from the previous question that this is a perpetuity with constant growth, right? So in the first year, the cash flow in the first year was $35 million. Applying a present value formula for a constant growth perpetuity, we therefore work out the present value of the future cash flows of these projects, right? Our NPV is therefore the difference between 368 million minus 300 minus 20 million, right? So in this case, we have a positive NPV, yeah? So our decision rule would be to accept the project. Okay. So we went through all the calculations, all the basic calculations of the weighted cost of capital. To summarize, for these calculations, we have to work out first the effective tax rate, right? If the firm has any tax credit, for example, in this case, we consider the imputation tax credit, yeah? We then work out the cost of common equity, the cost of preference shares, the cost of different types of debt. We might have more than one types of debt here, right? So we talk about bank loans, we talk about bonds, and we talk about short-term discount securities, yeah? So once we work out the cost of debt, we then have to treat for taxes. We then work out the market values of different types of finance. And finally, the weighted cost of capital, right? So where does issuance costs come in here? Issuance cost shouldn't affect our weighted cost of capital, right? As we mentioned before, it's a one-off cost, and therefore it should just affect the cash flow at the time of the issuance, normally at time 0, right? So to bring everything together, let's go through 2 exercises relating to the cost of capital, yeah? We also have a big exercise as well at the end of the workshop this week, where we look at a more comprehensive case with different types of finance, and we try to work out the overall cost of capital from that calculation, yeah? So let's look at exercise 1 for now. What do we have in exercise 1? We're given the interest rate, which is the cost of debt. We're also given the statutory tax rate. Right, so this is per annum. Right. We also know the proportion of tax claimed by shareholders. So this is the proportion of franking credits, right? Should be gamma here. So 60% of the total tax payments by the firm are distributed back to shareholders as franking credits, right? So this means that 60% of the firm's tax is not payable, right? We know the market value of debt. We also know the cost of equity. And finally, the market value of equity, right? So how do we bring everything together? Okay. So we start again with the weighted cost of capital formula. Here we also have two types of finance. We only have one debt security and one equity security. Yeah. So we once again look at this formula. We also know that V is equal to D plus E, right? Okay. And all these numbers are market values, yeah? V, D, E are market values, right? So we put all the information that we know in this table. We know the market value of the debt, we know the market value of the equity, and therefore the firm value is equal to the sum of these two, which is $20 million. Yeah. We know the average cost of debt and average cost of equity being 10% and 20% respectively. We then treat for taxes. So before we calculate the after-tax cost of debt, we need to adjust the tax rate for the amount that the firm doesn't pay, right? So this is the amount of franking credits here. Our statutory tax rate is 30%. The amount of tax distributed back to shareholders as a tax credit is 60%, and therefore the firm only pays 40% of its tax, right? As a result, the effective tax rate is only 12%. Yeah? We then use this rate to work out the after-tax cost of debt. And this is our result, right? The after-tax of equity is exactly the same as the before tax cost of equity, right? We then work out the weighted costs of debt and equity by multiplying the cost of debt or the cost of equity by the weights, right? So this weight is given by 10 million divided by 20 million, right? So the total of firm value is 20 million. The value of debt is 10 million, and therefore the weight for debt is 50%. Yeah. We do the same exercise for equity, and this is what we work out. Yeah. So the weighted cost of capital is simply just the sum of the weighted cost of debt and the weighted cost of equity, right? So here we work out that it's 14.4%. Yeah. Exercise 2. So for this exercise, it's a bit more complicated than exercise 1. Here we take into account 5 types of financing. Yeah. So in this firm's capital structure, we have 3 debt instruments. And we have 2 equity instruments, which we'll see later on in slide 34. We also know the market value of these different instruments, as well as the cost of these instruments. Yeah. So this is the before tax cost. So on this slide, we know that there are 2 equity instruments, being the preference shares and the ordinary shares or the common shares, right? This is once again the market value of these different instruments. This is the cost. And we also know the effective tax rate in this case, right? So this is TE. We don't have to do any calculation here. Yeah. Right. So what do we have here? So from the previous question, we can work out that the sum of the value of debt is 40 million. The sum of the value of equity is 40 million. And therefore the value of the firm will simply just be the sum of these two sums, right? So that's 80 million. Using the equation for Wacc, we know that we have to calculate the average cost of debt, the average cost of equity, and then we times it by the relevant weights, right? For debt financing, we also have to adjust for effective tax rates, yeah? So how do I measure the average cost of debt? This item here would simply just be the weighted costs of individual debt instruments, right? Okay. So we have three types of debts from the previous slide. So from slide 33, we have the commercial bills. The market value of the commercial bills is 20 million. The total value of debt was 40 million. And therefore this is the weight of the commercial bill, right? The cost of the commercial bill is 60%. Is 6%, sorry. We also have the overdraft, which is worth 8 million. So this is the weight of the overdraft. The cost of the overdraft is 10%. So this is the weighted cost of the overdraft. Yeah. We have bonds. So 12%, 12 million in bonds. Therefore, this is the weighted cost of bonds, right? So using this formula, we work out the weighted cost of debt. We then times it by the after-tax rate, the after-tax amount, and then times it by the weight of debt, right? We do the same exercise for the two types of equity. We then can work out the average cost of equity, right? So our final result here is 64% per annum. An easier way to do this exercise, so besides this two-step process, we can also do a one-step process where we calculate directly the weighted costs for individual instruments, right? And if it's a debt instrument, we have to adjust for after-tax costs. If it's an equity instrument, we just have to leave it alone, right? So we're going to go through some exercise later on in the workshop where we follow the direct measure, the direct way of measuring the weighted cost of capital, right? Okay, so far we've looked at the calculation of the overall cost of capital. In the next few slides, we'll be looking at how to measure a project cost of capital. Yeah. So we mentioned before that the principle of measuring the cost of capital is that the cost of capital has to reflect the project or the company's specific risk, right? So if we have PHB, the cost of capital has to be reflecting PHB risk. Yeah. If we have CBA, we have to use CBA's total risk as the measure for the cost of capital. Right. So given that if we have a project that has a different risk compared to the overall company's risk, we therefore have to measure the project's cost of capital differently from the company's cost of capital. Right. In special cases where these two conditions are met, we can also assume that the project's cost of capital is equal to the company's cost of capital, right? So what are the assumptions here? The first assumption is, as we mentioned before, if the risk of the new project is the same as the risk of the company, say if we just expand, right, an existing business, so the risk of the expansion is exactly the same as the current business. Yeah. We also have the second condition here where the project does not change the company's overall capital structure, right? Okay. So besides extensions of current business, companies can also go into different industries to make investments, right? So for example, we have PHB being a mining company, investing in the retail sector, for example, yeah, like buying a fashion brand. Okay. So in this case, we can expect that the firm's overall cost of capital or the firm's overall riskiness to be different from the riskiness of the project, yeah. So what do we do in this case? Okay. So if we were to use the firm's overall cost of capital to make the investment decisions relating to the new project, we might end up in one of these two situations, yeah. So with the first case, if the project is riskier than the overall company, we might accept negative NPV projects, whereas for projects that are less risky than the company, we might reject a positive NPV projects, right? So we're gonna see an illustration of this situation on the next slide. So this graph here illustrates how by using the same weighted cost of capital, we might misprice certain projects, yeah. So suppose that we apply the same cost of capital, which is the firm's overall cost of capital, to evaluate both projects A and B. Suppose also that this is a fair price, or this is the accurate relationship between systematic risk and the rate of returns, right? So here we're using beta to measure the systematic risk of different projects. So suppose that, so in the market, if we have some certain, if we have another project with the same systematic risk as A, this project yields KZ, for example, whereas A here, we can see that K, the required rate of return on K, or the expected return on K, is a little bit higher than KZ, right? So this is what the market performs. This is our project. So clearly we can see that our project outperforms the market, yeah? In the case of B, this is B's beta. So at this level of risk, the market earns KY, for example, whereas our project B only earned this much, right? So the implication here is that B is underperforming compared to the market, right? Whereas A overperforms or outperforms the market, yeah? But if we use K here as the cutoff, so if our decision rule is that we accept any projects that use more than K, then what do we do here? If our decision rule is to accept any project that use more than K, we would therefore reject project A, but we accept project B, right? Clearly from this graph here, we see that we should pick A if we were to use this line to evaluate project risk, right? Similarly, according to this line, this is the security market line, project B should be rejected because it's underperforming compared to the market, but because we use K as the overall required rate of return, we accept project B, right? Because project B's required rate of return is higher than K. Okay, so by using just the same cost of capital or the same required rate of return for all projects, regardless of the riskiness of the project, we might end up accepting underperforming projects and rejecting overperforming projects, right? Okay, so we established before that for a project with different risks compared to the firm's overall risk, we can't use the firm's overall risk to measure the project cost of capital, right? So in this case, what can we do? If the project's risk is different from the firm's overall cost of capital, one approach to measure the project's cost of capital is to identify a competitor that operates solely in the industry that the project is operated in, right? So if we were to buy a fashion brand, we want to compare our acquisition, with another company that only operates in the fashion industry, right? So this is what we call a pure play approach. So because this competitor operates solely in that industry, then the business risk of this competitor should be identical or should be close to the project's to the project's riskiness, right? As such, the cost of capital for this competitor should be close to the project's cost of capital. Yeah. So once we identify a pure play company, we then estimate the beta of the pure play company's equity. Now, because the risk of equity is comprised of business risk as well as financing risk, this is what we established from the previous topic, where we say that the shareholders is the one that bear all the financing risk, right? So the riskiness of the competitor's equity reflects both the business risk of the competitor as well as the financing risk of the competitor, right? But what we want here is we want a measure that captures only the business risk of the competitor, right? So what we have to do next is therefore to adjust for the financial leverage of the competitor, okay? So that we get an overall measure of just the business risk of the competitor, right? So once we have the business risk of the competitor, we would then use the CAPM model. We put in the business risk of the competitor in the CAPM model to estimate the cost of equity for the project, right? We then use the cost of equity estimate that we obtained from this step, and we adjust for the target debt and equity ratio of the firm to get the weighted cost of capital here, right? So in the final step, we then adjust the cost of equity for the project by taking into account both debt and equity in here. So as an example, to illustrate this method, let's look at an example 14.3 from the textbook, right? So in this example, we have a company that is operating in two different divisions, right? One division manufactures car parts, and the other division distributes agriculture machineries, right? So these two divisions are quite different. We also know the target debt equity ratio for the firm, and this will not be changed by the new projects. Yeah. We also identify a competitor that has the same business risk as the new project, right? So this is our pure play competitor. This competitor has a different capital structure, right? We know also the equity beta of this competitor. We are also given the information about the risk-free rates. We know something about market premium as well, right? we assume further that our company borrows at the risk-free rate and the tax rate is 30%, right? The proportion of tax collected from the company claimed by the shareholders is 60%. So this is the proportion of franking credits, yeah? As a result, the effective tax rate for this company is only 12%. So before we start looking at the solution, there are a few assumptions here that we have to make. Firstly, as the example show, we assume that our companies borrow at the risk-free rate, right? So both companies can borrow at the risk-free rate, which is 9%. So what it means is that because we are borrowing at the risk-free rates, and the risk-free assets has no relation to the market, right? So the beta of the risk-free assets is 0, yeah? So risk-free assets don't vary with the market, and therefore its systematic risk is 0, right? Also, our asset beta is just the weighted average of the betas of equity and debt, yeah? So our asset beta is simply just the weighted average of debt beta and equity beta, yeah? So because we assume from here that the company borrows from the risk-free rate, that means that the company's debt doesn't vary with the market, yeah? So the debt here is risk-free, okay? So if the debt doesn't vary with the market, beta debt would be 0. So beta asset would be therefore given by this second component here, okay? So we know from before that the leverage ratio of style firm was 1:1, right? Meaning that this ratio here, E over V, would be 1/2, yeah? So from this equation, when we rearrange the equation, we have 1 divided by 2 times beta E, right? So beta E was 1.25. That gives us the equation over here, right? So using this equation, we therefore can find out that the asset beta for style firm is 0.629. Sorry, it's 0.625, right? In the second step, we then use this asset beta and we adjust it with the current firm's leverage, right? So we mentioned before that equity beta reflects both the business risk and the financing risk of the firm. We obtain the business risk from the first step, which is 0.625. In the second step, we want to take into account the leverage of the current firm, right, to reflect the financing risk of the current firm. So in here we want to take into account the financing risk, yeah? So how do we adjust for leverage here? So from this equation over here, what we know from this equation is that firstly, beta D, or the debt beta, is again 0. Secondly, beta asset is obtained from step 1, so that's 0.625. What else do we know here? We know that the leverage ratio for the current company is 1:3, right? That means that V is equal to 1 plus 3. Yeah. So if we rearrange this equation, this is what we get. Right, so beta A equals to 3 divided by 4 times beta E. Yeah. This is what we have from the first step. This is 0.625. This is what we want to work out. Yeah. So we rearrange the equation. Then we work out that beta E is 0.833. Yeah. So those two steps that we went through before gives us the equity beta for that particular project. Yeah. So this is not the firm, this is a new project, right? The beta here reflects the project's riskiness, right? After we take into account both the business risk as well as the financing risk of the firm. Yeah. So once we obtain this equity beta, we obtain the cost of equity, we then use this cost of equity in the Wacc model to work out the total cost of capital for the project, right? So this is project specific. We also assume that the project, the firm borrows from the risk-free rate, and hence this second component, right? The debt and equity ratio was given from before, and therefore our cost of capital is about 13.73%. Right. We next look at divisional cost of capital. Yeah. So assume that we have a company with different divisions. So we have a diversified company. We want to work out the cost of capital for just one division, right? So in this case, we want to work out the cost of capital for individual divisions. We make an assumption here. So our assumption is that the total firm's cost of capital is simply just the weighted average of the divisional cost of capital, right? So these are the divisional costs of capital, where the weight is given by the value of the division over the total firm value, right? So if we can observe the cost of capital for all the firms operating in a certain division, a certain industry segment, and also if we can observe the value of each division for the firm, we can then work out the appropriate cost of capital for each of the divisions. Yeah, so we'll see an example from the textbook. Okay. So let's look at this example from the textbook, example 14.4. So what we have here is we have three companies, A, B, and C, and they operate in two industries, right? Industry 1 and 2. We assume that these are all the competitors in these two industries. So industry 1, we have A, B, and C. Industry 2, we also have the same firm, right? A, B, and C. Okay. The only difference here is that in different industries, we have different market shares for different firms. Yeah. So let's look at company A first. Company A has 40% of assets in industry 1 and 60% of its assets in industry 2. Company B and C. Company B has 30% in industry 1 and 70% in industry 2. With company C, C has 80% in industry 1 and 20% in industry 2. Right. We further observe the total cost of capital for each industry, for each companies, right? So company A's cost of capital is 15.3. Company B's cost of capital is 15.85. And company C's cost of capital is 13.1. Yeah. What we want to find out here from this information is we want to find out the divisional cost of capital, right? Okay. So what we have here is the cost of capital for industry 1. This is the cost of capital for the overall industry 2, right? So given equation 14.11 from the previous slide, we know that the total cost of capital for the company would be equal to the weighted average cost of capital for each division. Yeah. So for company A, this is the total cost of capital. Company A has 40% in industry 1. So this is the weighted cost of capital for industry 1. And we have 60% in industry 2, right? So this is the cost of capital for industry 2. Okay. For company B, we can do the same thing. So we equate the total cost of capital for company B with the weighted cost of capital for divisions A, divisions 1 and 2, right? So on and so forth. So here we have a problem where we have two unknowns. So if we have two unknowns, we only need two equations, right, to work out the value of these two unknowns. So if we pick 2 out of these 3 equations, we can then work out the values of K1 and K2. Yeah. So we work out that K1 is 12% and K2 is 17.5%. Right. So to summarize, what we went through in this lecture is that we look at the calculation of the total cost of capital, which is simply just the weighted average value of the individual types of finance, right? So we have 2 ways to calculate the cost of capital. In the lecture, we went through an example where we used the first approach to measure the cost of capital, right? So what we did in the previous example was that we calculate the average cost of equity, then we times it by the weight of equity of total equity over total assets. We then do the same thing with the cost of debt. We calculate the weighted average cost of debt, which is simply just the value weighted average of individual debt instruments, right? We then adjust for taxes. So this is to adjust for tax shields from debt expense payments, right? Then we times it with the total value of debt to the total value of firm. Okay. We also have a second approach to calculate the overall cost of capital, which we'll be going through in the workshop later on. So with this approach, we directly measure the weighted values or the weighted cost of individual instruments, right? So if we have, say for example, 2 types of equity, we could measure the weighted cost of the first equity instrument. We then plus the weighted cost of the second equity instrument. Then we plus the weighted cost of debt, right? So whatever way you prefer, you should get the same answer using either of these approach, right? We also talk about projects cost of capital versus overall company's cost of capital. So we mentioned before that we can only use the total cost of capital to price a certain project if 2 conditions are met. The first condition being the project has the same business risk as the company, and second, the project doesn't change the company's cost of capital, right? the company's capital structure. We look at an illustration for how, using the same overall cost of capital, we might end up with accepting the wrong projects, right, and rejecting the wrong projects as well. Okay. So in terms of the calculation of the overall cost of capital, we have two inputs here. We first have to look at the capital structure to identify the mix of debt and equity, right? So we can have different types of debt and equity here, and we have to make sure that we take into account all the different types of debt and equity. The second point to note is that we always use market values as the weights, right? So D here, E here, and V here have to be market value. We only use book value whenever we can't estimate the market value, right? So for example, for non-traded securities, where we can't observe the market value of the securities, then it's okay to use a book value, right? We then look at the calculation of the required rate of return of different instruments, right? So the cost of capital, as we mentioned before, is the required rate of return from the investors, yeah? So that reflects the opportunity cost that the investor has to give up when they invest in our project, okay? So the pricing of these different instruments will cover into OS70, right? So we have, in terms of equity, we have common shares and we have preference shares. In terms of debt, we have private debt being bank loans. We have bonds, so long-term tradable debt. We also have short-term tradable debt, which is the discount securities, right? So all these things are the things that we have to know before. Last but not least, we have to think about the effect of taxes on our cost of capital, yeah? So tax comes in here, okay? So from this lecture, these are the things that we have to consider. Firstly, as we mentioned before, the types of debt and equity. Second, the tax treatment of debt and the effective tax rate. Third, market value as the weight. Fourth, the cost of capital should reflect the project specific risk or the company specific risk, right? So we have to be careful here if the project has a different risk compared to the company, right? Issuance costs. So issuance costs should not affect the value of the weighted cost of capital, because it's not supposed to be an ongoing cost, yeah? It should be adjusted straight away in the cash flows, right? Okay, so the project's or the company's cost of capital should reflect the risk of the project or the risk of the company itself, yeah? Finally, we look at the consideration for the capital structure, yeah? So we discussed these issues before. With equity financing, it's expensive, but it has no default risk, yeah? With debt financing, the presence of debt increases the total default risk because it introduces the financial distress risk, right? Or the financing risk of the firm. It has also some restrictions on how the firm can use their assets because of the collateral requirements and the covenant restrictions, yeah? Finally, the issues of dilution of control. So by issuing too much equity, existing shareholders lose some of the control rights, right? So these are the issues associated with the choice between the equity. Okay. So that concludes our lecture regarding the weighted cost of capital.